Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the program with us today for our latest installment of the Palisade Sprott Monthly Market Update is Rick Rule. Rick, how are you today?
I'm fine, Colin. How are you?
I'm excellent, thanks. And this is, in fact, the first time we've talked to you in 2018, so we missed a month there in January, and certainly no shortage of interesting things happening for the mining investor. I want to start, Rick, by asking you about the U.S. dollar decline, which has continued, and then headlines all over the place the last few days on inflation, which in my short lifetime, I've heard about the idea of inflation. I've never actually seen anybody talk about it.
Well, certainly the dollar weakness shouldn't come as a surprise to people who read the headlines. First of all, the Trump administration said that a weaker dollar would be helpful, in effect, talking the dollar down. And then, of course, the decision to give my generation a $1.5 trillion tax cut to be paid for by your generation, because it wasn't accompanied by any spending decreases. And then, of course, the decision on top of that to have an interim spending bill that added to this year's deficit by $300 billion. And to top it off, $1.5 trillion proposed spending on infrastructure, with no mention made as to where the money was going to come from. If somebody was concerned about headlines, perhaps they expressed themselves in the market. You know, Colin, when I was a little younger than you are now, I heard a little ditty that sort of explains the dollar's problem. It goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. And I think the weakness in the US dollar is probably very well explained by that little ditty and by the headlines surrounding the budget and the deficit.
Rick, I've heard many times people say that gold acts as an indicator for inflation, but ahead of time, and certainly gold has not been performing poorly, but based on how much the dollar has declined and now this government inflation perking up, wouldn't one think that gold would have moved a bit more in advance of this?
I think people need to understand that reactions take place gradually. I'm very impressed, frankly, with gold's performance in the last 12 to 14 months. The gold price did extremely well in 2017, despite some very strong headwinds against it, the first of which is the fact that nobody cared. The second of which is that people believed, at least through 2017, that liquidity was a sort of a salve for the ability, for solvency, for the ability to actually repay. During that period of time, the very low interest rates that we enjoyed, if that's the right phrase, were evidence in and of itself that there was a lot of confidence in the system, and gold did fairly well. My suspicion is that the set of circumstances that you're seeing playing out in the market will mean that gold will continue to do well. I think the problem is really with investors' perceptions rather than with gold's performance.
Rick, when the Dow had that crash day just a few days back, gold didn't drop. In fact, it went up a couple dollars in dollar terms. I found that surprising, or at least a very positive sign, because going back to 2008, gold investors remember getting beaten pretty hard along with the crash that happened. Did you take any note of the fact that gold performed well on that day?
Yes, Colin, I must admit that I did. I try to discipline myself never to pay attention to one day or even 1 week long events. What I find is that if I pay attention to the sort of noise, I miss the music. But I must say that on an event-driven day, when there was evidence of an absence of liquidity, at least on the bid side, the fact that gold held up well while the equities did poorly is evidence, at least, that there is a bid on the gold side, which is very strong evidence. I would caution you, as I have in the past, about reading too much into short-term events and focus on the arithmetic surrounding gold for the longer term.
Going back a couple years, I remember a lot of people saying, and I'm not necessarily saying that you did, but precious metals were really where people wanted to focus because global growth was an uncertainty, and of course industrial commodities are tied to global growth. But that picture seems to have changed now. In fact, over the last year or two, the industrial commodities have done well, some of them really quite well. What's your picture on industrial metals versus the PMs?
I think in terms of the equities, the precious metals equities will perform sooner than the industrial materials equities, precisely because the industrial metals equities performed well in 2017 and the precious metals equities did poorly. In other words, I think the precious metals equities need to sort of catch up. I have always been more of an optimist than a pessimist. I believe, like Doug Casey says, that the greatest unbroken bull market that we've ever experienced has been the ascent of man, and I think that the ascent of man will continue. I just think it'll be punctuated by some fairly ugly down episodes. The consequence of all that is that I believe that intelligently constructed portfolios should have, particularly during periods when they're cheap, an exposure to economically sensitive commodities at the same time that they should have exposure to precious metals and precious metals equities, perhaps fulfilling different functions in a portfolio, but emphasizing each when it is at its weakest.
In the past, you've quoted a statistic outlining just how little percentage ownership of gold and gold-related equities are in, I believe it was the average Canadian's portfolio, and right now, or last time I heard it, it was well below 1% against the average of 3% and maybe a high of 8%. What's it going to take for those type of people to get gold back into their portfolio?
The actual statistic relates to American portfolios, and it suggests that between 1/3% and 0.5% of the investing and savings matrix in the United States was invested in precious metals and precious metals equities, relative, as you said, to a high in 1981 or 1982 of 8.5%, and a median, a 3-decade median of about 1.5%. My suspicion is that all that's required is time, perhaps 3 years, perhaps 4 years, perhaps 5 years, for precious metals and precious metals related equities to revert to the mean. I'm not suggesting that they're going to go to 8.5% market share. I'm suggesting that they're going to go to a 1.5% market share, which would triple or quadruple demand for precious metals and precious metals related equities in the largest investment market in the world. And I think that's all that's going to be required is time, frankly. I realize for some speculators who own precious metals related stocks that may or may not have any precious metals in their portfolios, that they can't afford the luxury of time. But for people who have constructed portfolios intelligently, the truth is that 2 years or 3 years or 4 years isn't an extravagantly long time to wait, particularly given the dimension that usually accompanies an increase in the gold price and the price of precious metals related equities.
Precious metals, as you mentioned, have strong potential to perform well. I want to get your reading on any other particular commodities that you're focusing on for 2018.
Well, I have always loved the copper business, and it's true I don't like it as much now at 320 as I did at 220. But the truth is that in the copper business, an extended period of very low copper prices stimulated some demand, but it also constrained supply, which is a very good thing. So I like the copper business. I liked the zinc business and continue to like the zinc business, although the zinc stocks have been on an absolute tear. I like the nickel business, but I'm really attracted, Colin, to things that other people hate. So the sectors that really have my attention right now are the agricultural mineral commodities, phosphate and potash, which can't seem to catch a bid. And of course, my perennial favorite, the uranium business. I suspect it'll be 2 years or 3 years before I'm happy with that trade. But the truth is, at age 65, I've been through an awful lot of 3-year periods now, and it doesn't seem as long as it used to.
Rick, when looking at something like the phosphate space, most of those projects that I've seen are very large in size. They require tremendous capexes. I guess you could say most of them are optionality plays. Would that be the way that you would play this kind of space, is just looking for an out-of-the-money option?
Well, I think there's two different ways. I think that investors can play the space in the largest and finest agricultural minerals company on the planet, Nutrien. Other investors like myself that have some courage for perceived political risk can, of course, play the Russian names, which are lower cost producers. But speculators, and I presume that most of the people who listen to either you or I are speculators, shouldn't be afraid of solvent optionality plays, circumstances where the front-end capital required to build the project might be $1 billion, but where the market cap is $30 million, and the market cap could be $300 or $400 million in a set of circumstances where the agricultural minerals industry earned enough money to earn its cost of capital.
Excellent. Well, I want to finish off with a listener question, Rick. One listener submitted a question regarding your position in Ivanhoe, asking if you still hold the shares and what your thoughts are on the company given recent updates.
Absolutely. My long-standing suggestion to Sprott clients, and understand that I can't give investment advice to a listener of yours whom I don't know, but my long-standing advice to Sprott clients whom I do know was to sell enough Ivanhoe that they had recaptured their initial capital back. Not a very hard thing to do in a dollar stock that goes to $5. I should note, however, that I didn't follow that advice myself. I still have all of the shares that I had. Ivanhoe is unique in that they have 3 or 4, depending on how you count them, world-class mineral deposits in one wrapper. They have world-class joint venture partners, Zijin Mining, backed by the government of China, and of course Jokmek, backed by the government of Japan. They do offer up perceived political risk in spades. South Africa is a troubled country, and Congo is a really, really, really troubled country. For people who believe in the resource thesis, and for people who have had courage sort of tempered into them by volatility in the past, this is a unique speculation. For others who can't afford, either financially or psychologically, to take the risk associated with capital-intensive mine developments in countries that scare them, there is no amount of potential profit that's probably worth the discomfort that you're going to experience owning this stock.
Rick, you are in a business that we at Palisade are not, and that's dealing with money management. You always offer to our audience, if they're interested, to reach out to you or a member of your team. Is that still something that's open for our audience to reach out?
Absolutely. If your listeners and readers would like me to offer up a no obligations review of their natural resource securities portfolio, they should email them to me at contacts@sprottglobal.com. And I certainly invite all of them to visit our website. We have over 200 hours of instructional material at www.sprottglobal.com. I guarantee that your listeners will get their money's worth from both offers because they're absolutely free.
Excellent. Rick, thank you again for coming on the program. Always a pleasure.
Always my pleasure. Good luck to you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?